The Great Depression, which lasted from 1929 to 1939, was the worst economic downturn in the history of the industrialized world. It began with the October 1929 stock market crash, which threw Wall Street into a frenzy and wiped out millions of investors. Consumer spending and investment fell over the next several years, resulting in sharp drops in industrial output and employment as faltering companies laid off workers. By 1933, when the Great Depression had reached its apex, 15 million Americans were out of work, and nearly half of the country's banks had failed. The United States economy increased fast throughout the 1920s, and the country's overall wealth more than doubled between 1920 and 1929, a period known as the Roaring Twenties. The stock market, concentrated on Wall Street in New York City, was a hotbed of wild speculation, with everyone from billionaire tycoons to cooks and janitors pouring their savings into stocks. As a result, the stock market exploded, reaching its high in August 1929. By that time, output had already begun to fall and unemployment had soared, leaving stock prices far higher than their true value. Furthermore, wages were low at the time, consumer debt was on the rise, the agriculture sector was failing owing to drought and declining food prices, and banks had an excess of huge loans that couldn't be liquidated. During the summer of 1929, the American economy entered a minor recession as consumer spending slowed and unsold goods began to pile up, slowing factory activity. Nonetheless, stock prices continued to increase, reaching stratospheric heights by the fall of that year that could not be supported by predicted future earnings. On October 24, 1929, the stock market crash that some had predicted occurred as frightened investors began selling overvalued shares in large numbers. On Black Thursday, a record 12.9 million shares were exchanged. 5 days later, on October 29, or Black Tuesday, another wave of panic gripped Wall Street, resulting in the trading of approximately 16 million shares. Millions of shares were rendered worthless, and investors who had purchased equities on margin, with borrowed funds, were completely wiped out. As consumer confidence plummeted in the aftermath of the stock market crash, manufacturers and other businesses were forced to reduce production and lay off people. Wages and purchasing power declined for those who were fortunate enough to keep their jobs. Many Americans who were compelled to buy on credit became indebted, and the number of foreclosures and repossessions progressively increased. The global adherence to the gold standard, which linked countries around the world in fixed currency exchange, aided in spreading the United States' economic difficulties throughout the world, particularly in Europe. Despite assurances from President Herbert Hoover and other officials that the crisis would pass, things worsened over the next 3 years. By 1930, 4 million Americans looking for work were unable to find it. By 1931, the figure had climbed to 6 million. Meanwhile, the country's industrial output had been cut in half. Bread lines, soup kitchens, and an increase in the number of homeless persons became increasingly widespread in America's towns and cities. Farmers were unable to harvest their crops and were forced to leave them to rot in the fields while people everywhere went hungry. Droughts in the southern plains caused heavy winds and dust from Texas to Nebraska in 1930, killing people, cattle, and crops. The first of 4 waves of banking panics began in the fall of 1930, when huge numbers of investors lost faith in the stability of their banks and demanded cash deposits, pushing banks to liquidate loans to replenish their low cash reserves on hand. Bank runs swept the United States once more in the spring and fall of 1931. And the fall of 1932, with many of institutions closing their doors by early 1933. In the midst of this severe scenario, Hoover's administration attempted to assist failing banks and other organizations with government loans. The assumption was that the banks would then lend to businesses, allowing them to rehire their staff. However, in 1932, with the country stuck in the depths of the Great Depression and around 15 million people out of work, Democrat Franklin D. Roosevelt won the presidential election by an overwhelming margin. At the end of the 4th wave of banking panics, every U.S. state had forced all remaining banks to close by Inauguration Day, March 4, 1933, and the U.S. Treasury didn't have enough cash to pay all federal personnel. To address the country's economic troubles, Roosevelt took quick action, first declaring a 4-day bank vacation during which all banks would close so that Congress could approve reform legislation and reopen those banks considered to be sound. Roosevelt's government issued legislation aimed at stabilizing industrial and agricultural production, creating jobs, and stimulating recovery during his first 100 days in office. Furthermore, Roosevelt intended to restructure the financial system by establishing the Federal Deposit Insurance Corporation, FDIC, to protect depositors' accounts in the Securities and Exchange Commission, SEC, to control the stock market and prevent abuses like the 1929 catastrophe. The Tennessee Valley Authority, TVA, which built dams and hydroelectric projects to control flooding and provide electric power to the impoverished Tennessee Valley region, and the Works Progress Administration, WPA, a permanent jobs program that employed 8.5 million people from 1935 to 1943, were among the New Deal programs and institutions that aided in recovery from the Great Depression. When the Great Depression began, the United States was the only industrialized country without unemployment insurance or Social Security. Congress approved the Social Security Act in 1935, for the first time providing Americans with unemployment, disability, and old age pensions. In 1937, a severe recession struck, owing in part to the Federal Reserve's decision to raise its requirements for money in reserve. Though the economy began to improve again in 1938, this second severe downturn lost much of the gains in output and employment and extended the Great Depression's impact until the end of the decade. The Great Depression fueled the emergence of radical political movements in several European countries, most notably Adolf Hitler's Nazi regime in Germany. As a result of German aggressiveness, war broke out in Europe in 1939, and the WPA focused on building the United States military infrastructure while the country maintained its neutrality. During the Great Depression, 1/5 of all Americans receiving federal assistance were black, with the majority living in the rural South. However, agriculture and domestic work, two key sectors in which black employees were engaged, were not covered by the 1935 Social Security Act, leaving no safety net in times of uncertainty. Rather than firing domestic workers, private employers might simply pay them less without facing legal consequences. And, because all relief programs were managed locally, those relief programs for which African Americans were eligible on paper were riddled with discrimination in practice. Despite these challenges, Roosevelt's Black Cabinet, chaired by Mary McLeod Bethune, guaranteed that black advisors were present in practically every New Deal institution. The number of African Americans employed in government has more than tripled. With Roosevelt's decision to back Britain and France in their fight against Germany and the other Axis powers, defense industry ramped up, creating an increasing number of private sector jobs. The Japanese attack on Pearl Harbor in December 1941 triggered America's involvement into World War II, and the country's factories resumed full output. With increased industrial productivity and widespread conscription beginning in 1942, the unemployment rate fell below its pre-depression level. The Great Depression had finally ended, and the United States had shifted its focus to the worldwide war of World War II.